Hey traders, welcome back to another episode of SimplySafeFx. In this video, I'll be sharing 3 simple yet effective trading strategies that have been proven to generate up to $100 per day in profits. These strategies have been thoroughly back-tested to ensure a high win rate, meaning you can trust their effectiveness. Also, I've laid out clear, step-by-step instructions so you can start implementing them right away. No complicated setups, just pure trading efficiency. Without further ado, let's get into the video. Our first scalping strategy is the Asian liquidity sweep strategy, which is a highly effective scalping technique that capitalizes on liquidity manipulation during the Asian trading session to anticipate high probability reversals or breakouts in the London and New York sessions. This strategy is based on the principle that large financial institutions and smart money often create liquidity traps in the relatively lower volatility of the Asian session before making significant moves in later sessions. To implement this strategy, traders should begin by identifying and marking the Asian session equal highs and lows, which typically forms between 12 a.m. and 6 a.m. UTC time. The key concept behind this strategy is that price often sweeps liquidity on one side of this range before making a strong move in the opposite direction. If the price moves above the Asian session equal highs, breaking through the range but then quickly reversing and closing back inside, it suggests a potential short trade setup. Conversely, if the price drops below the Asian session equal lows but fails to maintain downward momentum, it signals a long trade opportunity as the market prepares to push higher. The next step in this strategy involves identifying high probability order blocks, which are areas where institutional traders have placed significant orders, leading to strong price reactions. Once an order block is identified, traders should shift to the 1-minute time frame and observe whether the price shows a clear shift in market direction after reaching the order block. This shift in direction is a key indication that a reversal may be forming. Once all necessary confirmations are in place, traders should execute the trade at the order block, ensuring a tight stop loss just beyond the zone to reduce potential losses while maximizing potential gains. For the first take profit level, traders should aim for a 1-to-2 risk-reward ratio, meaning that for every unit of risk taken, they should target at least double the reward. Once the first take profit level is reached, the trader should move the stop loss to the entry point to eliminate any risk of loss while securing partial profits. For the second take profit level, traders should target previous buy-side liquidity when taking a long position and previous sell-side liquidity when taking a short position, allowing them to capitalize on liquidity sweeps where the market tends to make significant moves. By combining Asian session liquidity traps, institutional order blocks, and structured risk management, this strategy enables traders to take advantage of predictable price movements and profit from institutional market behavior with high precision. Now, let's do some chart analysis. Let's take a look on the euro-dollar pair. The first step is to analyze the Asian session between 12 a.m. and 6 a.m. UTC time. During this period, the price forms equal highs and equal lows, creating a well-defined range that acts as a liquidity zone. As the London session approaches, price action shows a sweep of the Asian equal lows, where the market briefly moves below the range before quickly reversing back inside. This movement represents a classic liquidity grab, a scenario where institutional traders collect sell-side liquidity before shifting momentum in the opposite direction. Additionally, price retests a previous bullish order block, reinforcing the potential for a strong upward move. With this confirmation in place, we now shift to the 1-minute time frame to refine our entry. Upon closer analysis, we observe that after a retracement into the higher time frame 15-minute order block, price forms a clear change of character, indicating that bullish momentum is gaining strength. This serves as a strong signal to enter a buy trade. To optimize the entry, a buy limit order is placed at the bullish order block, ensuring that the trade aligns with institutional order flow. To manage risk effectively, a stop loss is set just below the order block or beneath the most recent swing low, minimizing potential drawdowns while maintaining a strong risk-reward ratio. For the first take profit level, traders should aim for a 1-to-2 risk-reward ratio, capturing an initial portion of the move while securing profits. Once this level is reached, the stop loss is adjusted to break even, ensuring the position is risk-free while allowing for further upside potential. For the final take profit, traders should target the previous buy-side liquidity, where price is likely to react due to resting orders from market participants. In this scenario, a take-profit level can be set at this area, providing an opportunity to achieve a 1-to-4 risk-reward ratio. For traders looking to maximize gains, a re-entry opportunity may arise as the bullish momentum continues. If price retraces and creates a break of structure entry model, traders can consider scaling into the trade. However, to maintain a controlled risk approach, it is recommended to reduce the risk by half when executing additional entries. Our second scalping strategy is the 1-minute order block strategy, a powerful technique based on smart money concepts that focuses on identifying order blocks, which are key areas where institutional traders place their positions. To apply this strategy, start by analyzing the 15-minute chart to analyze the recent market structure. If you are not familiar with how to analyze market structure, make sure to check out these videos for a deeper understanding. For an easier approach, you can use 2 exponential moving averages as a trend filter. If the EMA 50 is above the EMA 100, you should only look for long positions, while if the EMA 50 is below the EMA 100, you should only look for short positions. Then, mark the high probability order blocks. Once they are identified, switch to the 1-minute time frame and wait for a change of character, which occurs when the price shifts direction after reaching the order block, signaling a potential reversal. After confirming the setup, enter the trade at the order block, ensuring a tight stop loss just outside the zone to minimize risk while maximizing potential gains. For take profit 1, aim for a 1-to-2 risk-reward ratio, and once it is hit, move the stop loss to break even to secure profits and eliminate risk. For take profit 2, target the previous buy-side liquidity when going long and the previous sell-side liquidity when going short, maximizing gains by capitalizing on liquidity sweeps. Let's apply this strategy in a real trading scenario using gold pair. The first step is to analyze the 15-minute time frame to assess the overall market structure and identify key order blocks. In this case, the market is uptrend with a series of higher highs and higher lows forming on the 15-minute chart. To further confirm the trend, we apply 2 exponential moving averages, EMA 50 and EMA 100, as a trend filter. Since the EMA 50 is above the EMA 100, we will only be looking for long trade setups, ensuring that we align our entries with the prevailing market trend. With the market structure and trend direction confirmed, we now shift our focus to identifying a high probability bullish order block. We spot a strong bullish move where price aggressively broke structure to the upside, leaving behind an unmitigated order block at a key level of support. We can switch to the 1-minute time frame to refine our entry. After a change of character model is set, we set a buy limit order within the 1-minute order block, ensuring an optimal entry with minimal drawdown. A tight stop loss is placed just below the order block or the recent swing low, reducing potential risk while allowing the trade to develop. As price begins to push upward, our entry is triggered, and we closely monitor the movement. For take profit 1, we aim for a 1-to-2 risk-reward ratio, which means that for every unit of risk taken, we are targeting double the reward. Once the first take profit level is reached, we move our stop loss to break even, securing profits and ensuring that even if the market reverses, the trade remains risk-free. As price continues its bullish momentum, we hold a portion of our position to target take profit 2, which is set at the previous buy-side liquidity. This level represents an area where stop losses from traders holding short positions are likely resting, and as liquidity is taken, the price is expected to react. Eventually, the price reaches this buy-side liquidity zone, triggering our final take profit, and we fully exit the trade with a strong profit. To execute this strategy effectively, start by analyzing the 15-minute market structure to identify the overall trend direction and key price movements. This step provides insight into whether the market is trending upward, downward, or moving sideways, helping traders make informed trade decisions. At 9:30 a.m. Eastern Time, when the New York Stock Exchange, NYC, market opens, mark the high and low of the first 5-minute candle. This candle acts as a crucial reference point for potential breakouts, as the market often experiences heightened volatility at this time. Once the range is established, switch to the 1-minute time frame and apply the break of structure entry model. If the price breaks above the high of the 5-minute candle, it signals bullish momentum, presenting an opportunity for a long trade. In this case, traders should look for bullish fair value gaps or order blocks to refine their entry. Okay, firstly, if the price breaks below the low, it indicates bearish momentum, making it a setup for a short trade. Here, trades seek out bearish fair value gaps or order blocks for entry confirmation. This strategy allows traders to capitalize on strong price movements typically seen at the New York Open, providing a structured and momentum-driven approach to trading. Let's do chart analysis on NASDAQ. The first step is to analyze the 15-minute market structure to determine the trend. In this case, the NASDAQ has been forming lower highs and lower lows, confirming a downtrend. At 9:30 a.m. EST time, we mark the high and low of the first 5-minute candle. This range acts as a key reference point for breakouts. Now we switch to the 1-minute time frame to wait for clear break of structure. As price break through the 5-minute low, we place a sell limit order at this significant fair value gap. A stop loss is placed just above the order block to control risk. For take profit, we aim for a 1-to-2 risk-reward ratio to secure quick profits. Once price reaches this level, we exit the trade, locking in gains and avoiding prolonged exposure. This strategy allows for a fast in and out execution, taking advantage of the New York Stock Exchange open volatility while keeping risk controlled. That wraps up today's video about top 3 scalping strategies. Be sure to check out other videos in our Smart Money Scalping series. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you never miss out on our latest trading strategies and insights. Thanks for watching, and I'll see you in the next episode.